Hello, and welcome to the final cap strat this week of 2023. We've got an exciting market update. We've got some Fed talk for you today, and let's get right into it. We can start with market returns for the week ended 12/15. Whole lot of green on this board, Mike. What happened?
Well, the Fed cemented the Immaculate landing narrative or regime that the market was trying to price in. The Fed surprised us and surprised many in a couple ways. We're going to talk about that later. And what you see is green across the board. And since November 1st, we're now looking at 20% gains for small caps from those lows. And, large caps up almost 13%. On a price basis, the S&P 500 is basically back to all-time highs, which is crazy to think about. Since December 2021, the market priced in the second most aggressive rate hiking cycle in history, and the Fed followed through on that. And your return over that time period is pretty much just the dividends.
Yeah. It's fascinating to look at these 2-year numbers after everything that the market and economy has gone through, and basically just been collecting your dividends on large caps.
Yep.
Pretty flat price-wise.
So yeah, large caps have climbed the wall of worry. They're back near all-time highs. Small caps still are about 20% below their all-time highs. So we think that's one of the reasons why you saw small caps outperform last week and since November 1st is if there is catch-up potential, that's where it is in the market.
Yeah, certainly. And it wasn't just equities that generated positive returns last week. Green across the board within the fixed income space as well.
Yep. Yeah, the 30-year Treasury now up 19% since November 1st. I mean, basically lost that much from August 1st through October 31st. But the volatility across Treasury markets, I mean, it wasn't too long ago we were talking about a 5% yield on a 10-year or a 30-year Treasury. And now we're talking about a 4% yield. That big of a move in that short a period of time is huge. I mean, outside of a recession, that rarely happens.
Right. Yeah, things have been moving pretty quickly here over the past few months, but also to just kind of contrast the 2-year numbers on the fixed income side to the U.S. equity side, still, especially on that 30-year basis, still dealing with some pretty notable losses over the past 2 years as rates are still notably higher than where they were, before this rate hike cycle started.
Right.
We can wrap up on the alternatives front. Continue to see a lot of grains. The only red number on the board this week. Anything to comment on from an alternatives perspective?
No, I mean, you also see global REITs up 20% since November 1st. Yeah. I mean, you can put them right alongside small caps as areas of financial markets that have been really under pressure since the Fed has been raising rates and keeping them high. And this is one of the biggest relief rallies we've seen for a space like global REITs, since before 2022.
Yeah. Yeah, turning it into a nearly double-digit return year to date.
Yep.
All's well that ends well, I guess.
Yeah.
You mentioned the Fed. Obviously, that was the biggest market-moving event from the last week. So we wanted to dive in further on what we were expecting going into the Fed meeting and what we got from the Fed. And we'll start with expectations, as we've been talking about here over the past few weeks, couple months. What we were expecting was what we would call a hawkish hold from the Fed, with the primary idea being pushing back against this market narrative of rates are coming soon and they're going to come significantly.
Rate cuts.
Yeah. Did I say hikes? Sorry.
No, you didn't.
Rate cuts.
You said nothing.
To be specific. Cuts are the new hikes, right?
Right.
So that was the idea going in, right? From our perspective, push back on this idea that rate cuts are coming and keep pointing to the idea that inflation is not yet under control. Mm-hmm. We don't want to relive the 70s. Our number one objective is conquering inflation. What we got from the Fed is what we're calling a dovish signal. They, especially in the press conference and the Q&A afterwards, Powell kind of embraced this idea of let's talk about cuts. We are talking about cuts. We might cut, even though inflation is not yet back at its target. Yeah. So going from this, focusing on that one aspect of the dual mandate, inflation, to now bringing both aspects of the dual mandate into the conversation. Mm-hmm. A couple of things, we were really interested to see how they digested and communicated around going into the meeting. that they didn't really push back on, the first of which is that sticky core services CPI,
Right.
which we've got on this chart here. What were we thinking about that? How did the Fed react to this kind of information?
Well, the day before the decision, we received CPI data. And as we've shown before, we look at core CPI over different time horizons, all on an annualized basis. So month over month, 3-month annualized, year over year, which of course is already annualized. And we take an average of different components of core CPI that the Fed should, in our view, be laser focused on right now.
Mm-hmm.
So there's core CPI, super core, which is in the core bucket. You look at services and you strip out shelter. And then core sticky, the elements of core CPI where price changes are sticky. They don't reverse very quickly. And if you average those 3 metrics into our composite, look at them over different time horizons, what you see is all of these measures coming together and sort of flattening out at the 4% level, at around the 4% level.
Yeah.
So we thought that would get some airtime during the press conference or in the Q&A.
Right.
But it really wasn't even brought up. The fact that these levels of services inflation and these stickier elements of the core CPI basket, it doesn't look like a lot of progress is being made there. Right? In our view, this looks like what's being called the last mile problem, where getting that last little bit of inflation out is going to be much harder than knocking the top off of inflation when it was running in the 6s, 7s, because what's left is the sticky services, sort of tight labor market component, wage price spiral components of inflation. But they did not address it.
Yeah.
They did not. So that was a surprise to us.
Right. And the Fed is in this kind of tough situation where, I mean, certainly it's an interesting meeting for them to start embracing the idea of cuts, given some of this recent inflation data. Mm-hmm. But the more they start talking about cuts, the more they start guiding the market towards cuts, the market's going to digest that message.
Yeah, they're going to run with it.
And almost do the cuts for them, which
Right.
is another thing that they didn't really push back on too hard is financial conditions.
Yes.
And what we're looking at here, we've got our financial conditions index in blue, the effective federal funds rate in dark blue. And I mean, you could see just this significant move in financial conditions becoming notably looser.
Yeah.
And the Fed not pushing back against that idea, really.
Right. If you combine the tightening from the Fed with the loosening that financial markets have been doing in terms of, credit spreads are very tight now. Equity markets have been rallying. You look at currency markets, all of these areas of financial markets. According to financial markets, the tightening stopped in March, and we've been loosening ever since.
Yep.
Right? And moreover, every single time over this rate hiking cycle that we've gone into a Fed meeting with financial conditions loosening, markets rallying, credit spreads tightening, whatever, the Fed has come out and addressed it and said, hey, this looseness in financial conditions is a reason why we need to maintain a more restrictive monetary stance, because markets can undo this tightening we've done and undo the progress we've made on inflation. So we thought, heading into this meeting, you have this big loosening in financial conditions. Financial conditions, according to the Chicago Fed, are actually looser now than they were before the first rate hike in the cycle.
Yeah.
Right? Gets no airtime. So, you look at these two things and you say the Fed's reaction function has changed for sure. That's what was special about this FOMC meeting. These two things that were top of mind heading into every Fed meeting that really played a role in their decision making.
Yeah.
It appears that they are no longer that important.
Yeah. And this is really a fascinating chart to look at. You noted the relative level of financial conditions compared to when the rate hike cycle started.
Yeah.
But the other thing to look at here is if you look at the tightening of financial conditions, I mean, you could say, what, two-thirds of the total tightening in financial conditions was priced in before the Fed even made their first rate hike.
Yes.
Right?
Yes.
So this idea of the market doesn't really care where the Fed is at now. They care where the Fed is going to be. And they're going to be pricing in that message earlier and earlier.
Yes.
And so, this Fed meeting was really kind of a confirmation of a market theme that's been playing out since November 1st, as we show, November 1st in those performance charts, of this idea of that immaculate landing. The Fed is going to be able to proactively cut rates, tame inflation without driving us into a recession. And so what we wanted to look at was, maybe this meeting indicates that the immaculate landing from an economic outcome standpoint has risen. Maybe the probability of that happening has risen. So is it a good time to buy stocks? Is it a good time to get on board with that idea from an asset allocation perspective? And we wanted to look at, different areas of the market. How priced in is this immaculate landing idea?
Right. We're going to try to answer a few questions that we know are top of mind for people.
Yeah.
One is a viewer question, so we definitely want to address that. But the first is, all right, the Fed's going to be cutting. Soft landing is on the table. Do I get back in?
Yep.
All right. And as you said, markets will price in that potential outcome way before it actually shows up in the data. So what we do is we take 6 areas of financial markets, all of them are forward-looking, and we develop targets within each market regime. So this immaculate landing regime that the market's been working towards since November 1st, how do we know if that's fully baked into prices by now? So you look at the market implied change in the Fed funds rate. On November 1st, the market was expecting 33 basis points of rate cuts over the next 12 months. So, one cut, roughly, a little more than that. Now, we're expecting 1.4% in cuts. So twice what the Fed stated in their dot plot in the summary of economic projections. They were expecting maybe 3 cuts, 0.75% of cuts, almost twice as much as what the market said. Huge move. In our view, the immaculate landing would be fully priced in if the Fed funds futures market was pricing in about 1.5% of cuts.
Right.
Get us down to something like 4%, 3.75%. That in 2024. So we're almost fully baked in there. 2-year break-even inflation rates in October, they were running above 2%. Now they're at 2%. So that's fully been priced in to break-even inflation. Economic surprise and financial conditions index, those two combined are almost fully pricing in this immaculate landing. The spread on corporate investment grade bonds has gone down 30 basis points. That's fully priced in. The S&P 500 forward PE ratio, we went from 18.9 times forward earnings to now we're up to almost 22 times. That's the most expensive of this entire cycle. That's very expensive by historical standards. And the last piece is expectations for earnings in 2024.
Yep.
Coming into November, the market was expecting something like 6.7% earnings growth, which is okay. It's somewhat supportive. But now this, in our view, will be the last piece to sort of fully price in this immaculate landing. And we're already up to almost 9% earnings growth expected in 2024. So if you were to average all these metrics, you'd get something like 90% priced in. In our view, there doesn't seem to be a lot of juice left in this squeeze. So although the economic outlook may slightly improve if the Fed is going to be proactively cutting rates, the market, in our view, has almost fully baked that in. And so as an investor, you need to be looking at, well, where hasn't this fully been priced in, right? Mm-hmm. And we spoke to it off the top, one of the last few areas of the equity market that still has catch-up potential is the small cap area. Whether that gets realized or not, we'll see. This does not mean the game is over. The market may be basically declaring victory. Right? But we know the reality. Yeah. There's still a long way to go. A lot of economic data to come in. The Fed hasn't done anything. Right? They're on hold, so they still need to execute rate cuts carefully, not do them too prematurely and risk reinvigorating inflation, right? So there's still a long way to go, but in our view, it's totally possible that the market has fully priced in almost the entire rate cutting cycle already.
And we saw there's a precedent for that, especially from a financial condition standpoint. The majority of the hike cycle was priced in before the hike cycle actually started.
Exactly.
And it's important to note here, we called this meeting a big meeting, and all it really was an indication of potential willingness
Yes.
to proactively cut rates.
Yes.
There is nothing to be said at that meeting last week about the Fed's ability to proactively cut rates an appropriate amount and at an appropriate time.
Yeah.
So, when we take all of that into account, does last week's meeting, how would it change our outlook for the pace and timing of Fed hikes?
Yeah.
Cuts, I'm sorry. Hikes.
No, it's cuts. That's right. We've been talking about hikes for too long. We're talking about the pace and timing of cuts. I'm just distracted because you didn't wear your Christmas sweater. You were supposed to. Yeah. I wore mine. Anyway, so we thought base case was 4 cuts in the back half of 2024. We still think that's about the right number, right? The Fed said 3. The market's expecting more.
Yep.
The timing and the pace is where there's uncertainty. And the market is struggling with this, or not struggling that much. But there's an idea or an emerging narrative out there that the Fed could be open to something like 3 straight 25 basis point cuts starting in March, as early as March or even February, being an adjustment, and then holding through the election, right? And that's something new. Usually if the Fed changes course and they want to start cutting, they want to do it methodically and slowly. That's typically what they would do. Right. The idea is they could be much more tactical and take, cut, wait and see how the data evolves, just to make sure that they don't reinvigorate inflation. Right. Something like Alan Greenspan used to be able to pull off, but no one since has been able to pull off. So we'll see if that works out. We also had a viewer question.
Yes.
We want to get to that. What might be the reasons why, the 10-year Treasury yield at the end of October was at 5%, and now we're closer to 4%. And you see that everywhere, the 2-year yield, the 30-year yield. Well, at the end of October, what was fully priced in was the no landing regime. Higher for longer. The Fed, there were virtually no rate cuts priced in. There was concern about all this Treasury issuance dominating the market. And now we've gone from having no landing fully priced in at the end of October, very difficult environment for bonds and stocks, to now an immaculate landing almost fully priced in because of Treasury quarterly refunding announcements. You had 2 Fed meetings that cemented the pause and now signaled the cuts. You had a big inflation surprise from the October CPI report, and all the other data came in so-so. And so it just speaks to how volatile markets can be, the mood swings. Yeah. I mean, a total 180 in a month and a half, right? So don't extrapolate this out, right? Think where we'll be at 2 months from now. Markets could be pricing in something very different, even if the economic trajectory hasn't changed all that much.
Right.
Yeah.
Right. Exactly. And another lens we wanted to view that through is looking at 2024 outlooks and expectations for S&P 500 price level, right, at year-end 2024. And obviously it's everybody's putting their outlooks together towards the end of the year. We've had a lot of price action in the past couple of weeks, but let's just take a look at the range of forecasters for 2024 S&P 500 price targets. What's going on here? What should we take from this information?
Yeah, we've gathered, I think it's 17 top-down forecasts from the strategist at each major bank and investment shop on the street, as well as the bottom-up consensus. All the S&P 500 analysts, what do they think from a bottom-up on every stock? Compile those together. And all these forecasts just came out too soon, right? I mean, when these forecasts started to come out, the median, something like 4,950, 4,900 was the median, and that was about 10% above where we were. Yeah. Which pretty much is what happens every single year. The median forecast is 10% above the price that we're at before those forecasts are released, right? But now with this rally, what you're looking at is you're only about 5% below the median of all these price targets. And there's some clustering around 5,100, you're something like 8% below that. Yeah. So in any given year, 5-8% is okay. But our view is you're still going to be getting above 4.5%, maybe even above 5% yields on cash for at least the first half of the year. So given how expensive financial markets are across a variety of metrics. That's not a great trade-off in our view. That's actually not a very attractive starting point. In prior years, you've seen something like, well, consensus price target is 15% above current price and you get 0% on your cash. Okay, well, obviously the average forecaster is going to be wrong like they are every single year, but at least there's a decent upside to the alternative, which is cash. So we don't really have that this year.
Yeah. So kind of to summarize that idea, the even if the market is right and the immaculate landing is the economic outcome, which the Fed has never pulled off before, completing a hikes and a cut cycle without putting the economy into recession. Even if that happens, recent price action has already taken about half of your large cap U.S. equity gains you could expect in that scenario based on these 2024 forecasts.
Correct. Yep.
And your cash is yielding you 5.5% relative to those return expectations.
Yep.
So, yeah, certainly a tough sell. All right, should we get into framework aspects?
Quick hitters on the framework.
Quick hitters on the framework, looking at inflation.
Yep. What the CPI data, the November CPI report did for us is really cement our outlook for core inflation running in the 3% range throughout most of 2024. That stubborn services component, that sticky services component, plus this huge loosening in financial conditions we've experienced. So that's basically all the new data that's been processed there.
Yeah.
Yep.
And important to note, even if the Fed, signaling to these cuts and embracing the idea of cuts, the lowest FOMC member forecast for 2024 core inflation is still 2.3%.
Yes.
So not a single member of the Fed is saying we expect to get down to target in 2024.
Yep.
It's an interesting note there. Economic growth front, what do we want to make note of here?
Well, retail sales have been very resilient, even though student loans have been, well, some of them have been starting to be paid back. A lot of folks still aren't paying them back, which is what it is. But forecast for Q4, something like in Atlanta Fed GDP now, is back up in the 2% range. And so if the Fed is going to proactively cut, if they are, that's a big if for us, that would make us feel a little bit better about economic growth, and it might not slow as much,
right?
Particularly nominal growth.
Certainly on the nominal, yeah.
Right. That could also create an environment where inflation runs a little hotter, and so that would eat into a good chunk of that nominal growth. So the mix between real growth and nominal growth as we move into 2024 and how sticky inflation is, those will certainly be top of mind.
Yep. And then last item here before the recession signal, liquidity. Anything exciting on the liquidity front?
We talked about here in money supply how it looks like there's going to be this recovery, but it's not going to feel that great because all of the treasury issuance that's coming is going to basically perform the job of sucking liquidity out of the system. So you have, if the Fed does proactively cut, once again, a big if, hopefully that will offset a portion of that tightening that is done through the Treasury issuing bonds and banks having to take them down at auction and so on and so forth. But another thing that this market movement does, say you're a bank and you have a bunch of treasuries on your balance sheet and they all have big unrealized losses. Maybe they're available for sale, maybe they're hold to maturity. The market moves of the past month and a half have meaningfully reduced those unrealized losses. You're not necessarily going to rush out and make loans. Your net interest margins are still very compressed. It may not make sense for you to be extending loans everywhere, but you have to be feeling better about your balance sheet than you were.
Yeah, almost the exact opposite scenario of what we were seeing in March of the stress on the bank balance sheets and the concern of those unrealized losses.
Right.
Yeah. And then we can wrap up here with the recession signal. We talked about a couple of these items in this video shoot already. Equities and credit indicating much looser financial conditions continue to be very far away from a recession signal triggering level. We talked about the job market last week, initial jobless claims remaining quite healthy. Anything else to note from a recession signal perspective?
No, it seems like not a lot of people are losing their jobs around the holidays, which is great.
Great news.
Yeah.
Great news. All right, well, that will do it for CapStrat this week for 2023. When we come back for the new year, we'll talk investment framework details. You referenced earlier some potential attractive opportunities within the equity markets. We'll take a look at that. And if you have any questions in the meantime, please feel free to reach out. Have a great holiday season and a happy new year. And we'll see you in 2024.